Hey everyone, welcome. Today we're diving deep into the latest numbers from a pharma giant, GlaxoSmithKline. We're going to tear down their Q3 report and see what's really going on with the company.
All right, so here it is. This is the real deal, the official announcement that GSK put out. We're not messing around with secondhand info or what some analyst thinks. Nope, we're going straight to the source to get the real story on their Q3 performance. So here's the game plan. We'll give the quarter a quick grade, then I'll explain this key idea of standalone versus consolidated results. After that, we'll hit the big stuff. Sales, profit, what it means for you if you own the stock, and stick around because there's a little twist hidden in the details that you're going to want to hear.
Okay, let's jump right in. After any company drops their numbers, there's really only one question that matters, right? Was it a good quarter for GSK or a bad one? Let's figure it out.
But hang on, before we get to the numbers, there's something we got to clear up. Financial reports actually tell two stories at once. There's the standalone version and the consolidated version. And trust me, you need to know the difference to really get what's going on.
So first up, standalone. It's exactly what it sounds like. This is just the parent company, GlaxoSmithKline Pharmaceuticals, standing all by itself. We're only looking at the performance of the main business here, none of the other little companies it might own. Then you've got consolidated. Now this is the whole family picture. It takes the parent company's numbers and adds in the results from all the smaller companies it controls. Think of it as the total performance of the entire GSK group. Okay, so just to recap, standalone is just GSK India. Consolidated is the whole shebang, the entire group. Now both numbers are interesting, but most people, especially investors, really care about the consolidated results. That gives you the best view. So with that sorted, let's finally get into the numbers.
All right, first things first, we always look at the top line. That's just a fancy way of saying revenue or sales. Basically, how much money came in the door. So what's the verdict for GSK?
Well, if we look at just the main company, the standalone number, they pulled in a little over 102,000 lakhs in revenue. That's a big number, and it's all from their core operations.
But then, look what happens when we check the consolidated figure. The number jumps up to over 104,000 lakhs. That extra 2,000 lakhs? That's what the rest of the corporate family brought in. This is the number that shows you how the whole group is doing.
But you know, a number by itself is just, well, a number. The magic happens when you compare it. Look at this. Compared to the same time last year, consolidated revenue shot up from about 95,000 lakhs to over 104,000. That's a solid jump, and it's exactly the kind of growth you want to see.
Okay, so making a ton of sales is awesome, but it doesn't mean much if you spend it all, right? What we really care about is what's left over after all the costs are paid. That's the bottom line, the profit. So let's see how much GSK actually kept.
For the main company alone, the standalone profit came in at just over 27,700 lakhs. Again, this is just a measure of how profitable the core business was.
And when we look at the consolidated number, bam, it jumps to almost 29,600 lakhs. So just like with sales, those other companies in the group are pulling their weight and adding a nice chunk of profit to the total. And again, let's put this in perspective. Look at the difference from last year. Profit exploded, jumping from around 23,000 lakhs to over 29,500. We're not just talking about a little bit of growth here. This is a massive acceleration in how much money they're making. Investors definitely pay attention to stuff like this. So, okay, the company did great, but what does that mean for you if you own, like, one share of GSK? How do we break it down to that level? Well, that's where a little thing called earnings per share, or EPS, comes in. Looking at the standalone business, the EPS was 16.36 rupees. What that means is, for every single share of stock out there, the main company made that much profit this quarter. Pretty straightforward. But the consolidated EPS, the one that includes the whole family, is even better, 17.45 rupees. And this is the number that really matters to Wall Street. It shows the total earning power of the entire company boiled down to a per-share basis. All right, so if we stop here, everything looks amazing, right? Sales are up, profits are way up, looks like a home run. But there's always a but. You have to read the fine print, the little notes at the bottom of the report. And there's a really important detail in there that changes the story a little bit.
And here it is. This is a direct quote from the report. It mentions something called exceptional items. And what were they? Well, it turns out GSK made a bunch of money by selling off some extra residential properties and a plot of land they weren't using.
So why does this matter?
Well, it means a big chunk of that amazing profit we just saw didn't come from selling medicine. It came from a one-off deal, selling some real estate. Now that's great, money is money. But you can't sell that same piece of land again next quarter, right? It's not a repeatable core part of their business, and that context is absolutely critical.
So let's just recap everything. If you put the numbers side by side with last year, the growth is crystal clear. Revenue is up, profit is up, earnings per share is up. No matter how you slice it, it was a very, very strong quarter for GSK on paper.
And that brings us to the big question, the one that really matters for the future. We know GSK had a fantastic Q3, but we also know they had a little help from a one-time sale. So, the real test is, can they keep this momentum going? Can the core business, just selling pharmaceuticals, deliver this kind of growth next quarter? That's what everyone's going to be watching.
You know, there's this massive misconception out there
Oh, yeah. Yeah.
that looking at a stock chart is just, I don't know, looking at math.
Right. Cold, hard data.
Exactly, like a spreadsheet or a grocery list. But when you really strip it down, financial charts they're actually biographies.
That is a beautiful way to put it, a biography of crowds.
Yeah, they're heat maps of human emotion. You've got fear, greed, panic, hesitation, all just laid out in red and green bars. And today, we are reading the biography of a giant.
We are. And it's the biography that is currently at a fascinating plot twist.
We have the technical chart for GlaxoSmithKline, specifically the one trading on the NSE. And we're zooming in on exactly where it stands right now today, February 9, 2026.
And we're using a source from Nuvama to do it.
Right.
And if you were just, glancing at the headlines, you might totally miss the drama here. You might just think, oh, a pharmaceutical company, pretty standard. But the chart we have here, which covers what? The last 18 months or so, it tells a very specific story about a company and really a market that's trying to find its footing after a pretty wild party.
Exactly. So our mission for this deep dive is clear. We aren't here to give investment advice. We never do that.
Never.
And we certainly aren't pulling out a crystal ball. We are here to decode the signal from the noise. We're going to act like doctors looking at a patient's vital signs.
Checking the pulse, the blood pressure, the reflexes.
So let's start with that headline number, the vital sign everyone looks at first. As of the closing bell today, February 9th, 2026, where is Glaxo NSE sitting?
Okay, so we close the day at 2,516 and 20.
2,516 and 20. Now, to the uninitiated, that's just a price tag. It's a number. But you and I both know that a single price point is meaningless without the context of the battle that got us there.
Context is everything. To understand that closing number, you have to look at the candlestick for the day. That's that single bar on the far right of the chart.
Let's unpack that then, the anatomy of the day. Because it wasn't a flat line. We opened the morning at, what, $2,489 euro?
Correct. That was the starting gun.
And by the end of the day, we climbed to that 2,516 mark. So simple math here. The close was higher than the open. That gives us a green candle. The buyers technically won the day.
The buyers won, yes.
Yeah.
But it wasn't a victory parade. It was more of a skirmish.
A skirmish? How so?
Well, look at the wicks on that candle. You know, the little thin lines sticking out of the top and bottom?
Yeah.
They tell you about the struggle, the territory that was fought over but wasn't held.
Ah, I see that. We dipped as low as $2,475 at one point today.
That's the moment the sellers briefly took control. They managed to push the price below the opening bell. If you were watching the screen at that exact moment, the candle would have looked red. It would have looked weak.
Fear was winning.
For a minute, yeah. But then the bulls stepped in. They saw 2,475 and said, nope, that's too cheap, we're buying.
So they absorbed that selling pressure.
Precisely. They acted as a floor.
Right.
And they pushed the price all the way up to a high of 2,540,000 before it fell back a bit to the close.
That's a range of, let me do the math here, about 65 points?
Roughly 65 points, yes. Now, in the grand scheme of things, for a stock priced over 2,000, that might sound like background noise.
Right.
But think about the energy required to move a massive entity like Glaxo across a 65-point spread in just, 6 hours of trading?
It's heavy lifting.
It is. It shows the market is awake, it's engaged, it's not comatose.
So it's like a tug of war. The rope is moving back and forth, and when the whistle blew, the flag was resting on the buyer's side at 25.16.
But not by a huge margin. It was a contested win.
Okay, so that's the microscopic view, just today. But if we pull back, if we widen the lens to look at this chart from left to right, covering the last year and a half, Calling it a negotiation feels like a massive understatement.
It does, yeah.
I mean, looking at 2025 on this chart, it looks more like a roller coaster designed by someone with a grudge against safety regulations.
It really does. It has been a wild timeline. And to understand why we're sitting at 2516 today, you have to look at where we came from.
So take us through this timeline of drama, because on the far left of the chart, we're talking late 2024, early 2025. It looks pretty bleak.
It was the winter of discontent, if you will. You can see a very clear, persistent downward trend on that left side.
Lower highs, lower lows.
Yep. The market was pessimistic. Now, whether that was about the pharma sector or the stock specifically, who knows? But
It looks like it bottomed out right around January, February of 2025. That was the valley.
that was the dip. Sentiment was likely at its worst right there. But, as often happens in markets, maximum pessimism is often the precursor to a reversal.
And what a reversal it was. I mean, look at the spring of 2025. It stops being a stock chart and starts looking like a SpaceX launch.
We call that a parabolic move. From those lows in early 2025, the stock just shrimped. It took off. It didn't just climb, it accelerated.
I'm looking at the y-axis here on the right. It shot up from the low 2000s, past 2,500, past 3,000. It just kept going.
Yes, the peak of that mountain looks to be around June 2025. Visually, looking at the chart, it pierced well above the 3,290 level.
3,290. And just to remind everyone, we're at 2,516 today. So that peak was dizzying.
That was the euphoria phase.
Right.
When you see a vertical line like that, it's usually driven by FOMO, fear of missing out.
Of course.
Everyone sees the price going up, so everyone buys, which makes the price go up more. Volume explodes. Logic takes a backseat to momentum.
Everyone thinks they're a genius in a bull market.
Exactly. But gravity always wins eventually. The air gets too thin up there. The buyers run out of cash. The people who bought at the bottom decide it's time to, buy a new car, so they sell.
And that brings us to the second half of 2025, the cool down.
Cool down is a very polite way to put it. That looks like a stumble down a staircase.
It does. It wasn't a straight line crash, but the trend clearly flipped.
From June 2025 through the end of the year, the stock gave back a huge chunk of those gains. It fell from the 3,000s back down into the 2,500 range.
It's almost like the market had a massive hangover. It partied too hard in June and spent 6 months apologizing.
That's actually a very accurate description of market psychology.
Yeah.
It overshoots to the upside, then it overshoots to the downside. It's constantly seeking equilibrium, but rarely finding it.
Which brings us to right now. Late 2025, early 2026. The crash has stopped. The rocket ship hasn't relaunched. We seem to be just stuck in traffic.
We are in consolidation. That's the technical term for it.
Sideways city.
Exactly.
Yeah.
If you look at the price action for the last few months, the candles are mostly horizontal. We're just bouncing between a floor maybe around 2,400 and a ceiling around 2,600, just churning.
Is this normal after such a wild ride?
It's very normal. Think of it like a runner who just sprinted a marathon. They need to stop, hands on knees, and just catch their breath. Glaxo is catching its breath.
Now, there is a visual indicator on this chart that I find really helpful for seeing this breath-holding moment. It's those green lines.
Ah, yes.
The ones that look like snakes wrapping around the price bars.
The Bollinger Bands, one of my favorite tools.
I love the name. It sounds like a 1970s rock band. And now, the Bollinger Bands.
They certainly rock the world of technical analysis.
Okay, help me out here. I see a top green line, a bottom green line, and the price is sandwiched in the middle. What are these snakes actually telling us?
So, without getting too bogged down in the math, Bollinger Bands measure volatility.
Okay, volatility.
So, simple version. The bands act like an envelope. When the market is wild and volatile, the bands expand. The mouth of the snake opens wide.
I can see that on the chart. Back in April and May of 2025, during that rocket ship phase, the bands are huge. There's a massive gap between the top and bottom lines.
Exactly. High volatility. Now, look at the bands today on the far right of the chart.
They've shrunk. They are squeezed tight. They're running almost parallel.
That is what we call a volatility squeeze. The market has gone quiet. The price isn't banging against the top band, which would signal a breakout. It isn't crashing through the bottom. It's just floating.
So the green snakes are confirming our consolidation theory.
They are reinforcing it. They're telling us that the market participants, they've all agreed to a temporary ceasefire.
But the thing about ceasefires is they usually end.
You're getting ahead of the story, but yes, we'll get to that. But first, we need to check the engine gauges.
The panels at the bottom of the chart.
Right. Let's look at the first panel below the price action. It's labeled RSI 14.
That's the speedometer, right?
In a way, yes. RSI stands for Relative Strength Index. It measures the speed and the change of price movements. It's a scale from 0 to 100.
Okay, so if 100 is a Ferrari at max speed and 0 is parked in the garage, where's Glaxo right now?
As of today, the RSI reading is sitting right around 51 point ever.
51.
51.
That is painfully average.
It is the definition of neutral. In the world of RSI, you have two danger zones. If the number goes above 70, the stock is overbought. Too expensive, too fast, likely to fall.
Like back in June 2025.
Exactly. Look at the white line back then. It was spiking way up into the 70s, maybe 80s. That was the warning sign that the party was about to end. The engine was overheating.
And the other danger zone?
Below 30. That's oversold.
Yeah.
Everyone is panic dumped, and it's probably too cheap.
But we are at 51. We are Switzerland.
We are completely neutral. We're sitting smack in the middle of the road.
It's a stalemate.
It's equilibrium.
Yeah.
And honestly, 51 is sometimes the hardest number to read
Why is that?
because it offers no clues. At 80, you know to be careful. At 20, you know to look for bargains. At 51, you just have to wait.
Okay, one more gauge on this dashboard. The very bottom panel, the vertical bars, that's volume, right?
Correct. Volume is the fuel. It tells you how many shares are actually changing hands.
Why does that matter, though? If the price moves, isn't that all that counts?
Not quite. Imagine a price moves up, but only 3 people bought shares. That's a weak move. It's a bluff.
Yeah.
But if the price moves up and 3 million shares are bought,
That's conviction.
Then
That's a fact.
you got it. So looking at the fuel gauge for Glaxo, compare the rocket ship days of early 2025 to today.
Oh, wow.
Back then, you see these massive skyscrapers of volume, tall, jagged bars.
And today.
The skyscrapers have turned into little bungalows. The volume bars are low. They're consistent, but they're small.
So the big money isn't playing right now.
They're observing, keeping their powder dry. This low volume confirms the RSI neutrality and the Bollinger Band squeeze.
Yeah.
It all paints a consistent picture. The market is waiting.
Okay, so let's synthesize this for a second. We've looked at the price, the history, the volatility bands, the momentum, and the volume.
And the story is remarkably consistent across all of them. Glaxo NSE had a turbulent, frankly, a crazy year in 2025. It survived the crash, it found a floor, and now, as of February 9, 2026, it is taking a nap.
A nap.
Or perhaps.
Meditation. This brings me to the question I think every listener has right now. Is neutral boring? Or is neutral actually dangerous?
That is the million-dollar question. And this is where the art of technical analysis comes in to complement the science.
Well, on?
Most people look at a sideways chart, a chart with an RSI of 51, and they think nothing is happening. They get bored.
Right, they check out.
They think the story is over.
Yeah.
They sell and move to something flashy.
But you don't think that.
I get suspicious. Because markets despise equilibrium. They're not designed to stay still. A market that isn't moving is an anomaly.
So this period of quiet, this 51 RSI.
Think back to the Bollinger Bands, the squeeze. Imagine a coiled spring. You're pressing it down between your hands. The more you compress it, the more potential energy it stores. It isn't moving, but it certainly isn't at rest. It's under tension.
That's a great image. So the longer it stays compressed.
The more explosive the release will be when you finally let go. Periods of low volatility, like we're seeing right now, are almost always followed by periods of high volatility. It's the physics of the market.
So the market is storing energy for a big move.
Yes.
But here's the problem. The spring can uncoil in 2 directions. It can shoot up or it can shoot down.
And that is the mystery of the chart. The chart tells us the condition, which is compressed. It does not tell us the direction.
So are we storing energy for a launch back to those 2025 highs or a breakdown to the 2024 lows?
The chart is silent on that. It's waiting for a catalyst.
A catalyst? Like what?
Could be anything. An earnings report that surprises everyone. A new drug approval. A change in government policy. Or even just a big shift in the broader market.
So right now, the market is like a sprinter in the starting blocks. Muscles tense, waiting for the gun.
Exactly. And if you are an investor or a trader, this is actually the most critical time to be watching.
Why? Why not wait until it starts moving?
Because by the time the move is obvious, by the time the bands blast open and the volume spikes, the easy money has already been made. The professionals are positioning themselves during the quiet times. They're watching that resistance level at 2,600 and that support level at 2,400 like a hawk.
They're placing their bets before the wheel starts spinning.
Essentially. They're building a thesis. If it breaks 2,600, the spring releases upward, we likely see a rush of buyers, the RSI shoots up, and we chase those 2025 highs.
And if it breaks 2,400?
The floor gives way, the spring releases downward, and we could see a swift drop to retest lower levels.
So for everyone listening, do not let the boredom fool you.
Never. Boredom in the markets is usually just the calm before the storm.
That 51 RSI isn't a nothing number. It's the eye of the hurricane.
That's a great way to put it. You can stand in the eye and think the weather is fine, but the wall of wind is just a few miles away.
Before we wrap up, I want to go back to one thing you said. You said charts are maps of human psychology. When you look at Glaxo right now, sitting at 25.16, what's the dominant emotion?
Right now, it's ambivalence.
Ambivalence, that's a tricky one.
It is. It's uncertainty. The bulls are afraid to buy because they remember the crash of late 2025.
Mm-hmm.
The bears are afraid to sell because they remember the rocket ship of early 2025. Both sides are scarred, both sides are hesitant. And that's what creates this sideways churn. They are staring at each other across the battlefield, waiting for someone else to make the first move.
And it only takes one piece of news to break that stalemate.
Just one. And once that first move is made, the herd will follow.
So the takeaway for our listeners today?
Keep your eye on the green snakes. Watch for the volume to come back. That'll be your sign that the big players have returned. And respect the silence, because the market is speaking to you even when it's whispering.
I love that. Respect the silence.
Yeah.
We will leave it there for this deep dive. GlaxoSmithKline, NSE, February 9, 2026. The patient is stable, the vitals are neutral, but the pulse is waiting to jump.
Indeed. Stay curious.
We'll catch you on the next one.